Welcome to this explainer. Today, we are going to completely demystify the often intimidating world of the IRS. Seriously, if you've ever felt that pit in your stomach around tax season or worried about making a mistake that could cost you a fortune, you are exactly in the right place. We're going to transform you from a potential victim into an empowered player who knows the exact rules of engagement.
Here is our roadmap for today. We'll be covering surviving an IRS audit, the IRS ticking clock, the penalty minefield, the most dangerous tax penalty, and finally, your Taxpayer Bill of Rights.
Let's jump right into Section 1, Surviving an IRS Audit. Okay, let's address that universal stomach-dropping fear right out of the gate, the IRS audit, or as they officially call it, an examination. Before you panic, go ahead and breathe a massive sigh of relief, because the overall IRS audit rate is actually below 1%. The vast majority of taxpayers will literally never face one. But as business advisors or just informed taxpayers, understanding this process is absolutely essential, just in case you do fall into that tiny fraction.
Now, if that less than 1% chance becomes your reality, you really need to know what you're dealing with. There are four main types of encounters. It usually starts with simple automated notices for things like basic math errors or mismatched 1099s. Then there's the correspondence audit, which is handled entirely through the mail and is actually the most common type. Things get quite a bit more serious with an office audit where you meet an agent in person. And finally, the field audit. This is where the IRS agent actually visits your business to comb through your books. If that happens, you absolutely want to engage experienced tax counsel immediately. Regardless of which type of audit you encounter, the absolute golden rule here is this: never ever ignore an IRS notice. A simple mail audit can escalate dramatically if you just pretend it didn't happen. And here's a pro tip for you. When you do respond, only provide exactly what they asked for. Keep it super focused. Do not volunteer extra documentation or a backstory beyond the specific request.
Moving right along to Section 2, the IRS ticking clock.
It's incredibly important to realize that the IRS isn't some infinite, ever-present shadow hanging over your past tax returns forever. They actually operate on a strict ticking clock known as the statute of limitations. Generally, their window to audit your return closes after 3 years from the date you filed it. Now, if you omitted a substantial amount of income, we're talking more than 25% of your gross income, that clock extends to 6 years. And if they've already assessed a tax, they have a strict 10-year limit to actually collect it from you. Because of these rules, it's highly recommended to hang on to your records for at least 6 to 7 years.
But watch out, because there is a massive exception here. If you commit fraud, or if you simply fail to file your taxes entirely, that clock never even starts. In those scenarios, there is absolutely no statute of limitations, which means the IRS can come back and assess you indefinitely.
All right, let's get into Section 3, the penalty minefield.
We are now entering the most perilous territory of our survival guide. The IRS has a variety of ways to penalize non-compliance, and frankly, the math can get brutal. There is a staggering contrast between two of the most common penalties. The penalty for failing to file your tax return is a massive 5% of the tax due per month. Compare that to the failure to pay penalty, which is only 0.5% per month. Let that sink in. The penalty for simply not handing in your paperwork is literally 10 times higher than the penalty for not having the cash to pay them.
So, the ultimate takeaway, the golden rule of tax season, is that you must always file on time, even if you can't afford to write the check today. By filing on time, or at least filing an extension, you completely stop that massive 5% monthly failure to file penalty dead in its tracks. You can then arrange a payment plan for the balance, which actually drops your failure to pay penalty down to just 0.25% per month.
Beyond filing and paying, there are some other devastating landmines out there. If you have an underpayment due to negligence or a substantial understatement, you're looking at a 20% accuracy-related penalty. If they deem that underpayment to be fraudulent, that jumps to a crushing 75% civil fraud penalty, and criminal charges could even follow. Oh, and hovering over all unpaid balances is the interest. It's calculated at the federal short-term rate plus 3%. It compounds daily, and there is absolutely no ceiling to how high it can go.
Which brings us to Section 4, the most dangerous tax penalty.
This right here is the climax of our explainer. We've talked about accuracy, fraud, and late fees. But out of all these strict rules, timelines, and regulations, what do you think is the single most dangerous penalty a business advisor, an officer, or an owner needs to watch out for?
It's called the Trust Fund Recovery Penalty, or TFRP. This applies to trust fund taxes, which are the income tax, Social Security, and Medicare that an employer withholds from their employees' paychecks. You see, the moment that money is withheld, it legally belongs to the government. If you willfully fail to collect and remit those taxes, this penalty hits you for the entire 100% amount of the unpaid trust fund taxes. Not a fraction, the entire amount.
This specific penalty is uniquely terrifying because it completely bypasses the corporate liability shield. The IRS can and absolutely will assess this personally against any responsible person. That means officers, directors, shareholders, or even the company bookkeeper can be on the hook. And get this, dissolving the company or declaring bankruptcy does not wipe this slate clean. The personal liability sticks to you. Also, be warned, the IRS defines willful very broadly. If you know payroll taxes are owed, but you choose to pay your rent or your suppliers to keep the lights on instead, case law considers that willful. You literally have to pay the IRS before any other creditor.
Finally, let's wrap up with Section 5, your Taxpayer Bill of Rights.
Okay, I know that was a lot of heavy stuff, so to bring the tension down and re-empower you, let's explore your ultimate defensive shield. Codified into law is the Taxpayer Bill of Rights, guaranteeing 10 fundamental protections for every single U.S. taxpayer. These ensure you're treated fairly, provided professional and courteous service, and granted strict privacy and confidentiality. It guarantees your right to challenge the IRS's position and to not pay any disputed tax until you've exhausted your right to appeal. It also guarantees finality, which ties right back to those statutes of limitations we discussed earlier.
But your absolute most powerful defensive move on this list is right number 9, the right to retain representation. This brilliant rule ensures that you never actually have to speak directly to an IRS agent. If you find yourself in an audit or a collections process, you can hire an authorized representative like a CPA, an enrolled agent, or a tax attorney and instruct the IRS to communicate only with them. You are totally allowed to step entirely out of the line of fire.
Now, what if you're facing severe financial hardship, or normal IRS channels have completely broken down and failed to resolve an issue? You have a right to a fair and just system, and this is exactly where the Taxpayer Advocate Service comes in. It's an independent organization operating directly within the IRS that intervenes on behalf of taxpayers experiencing significant hardship. And the best part? Their service is entirely free.
So, we've covered the reality of audits, the strict ticking clock, the truly catastrophic penalties for failing to file or remit payroll taxes, and your legally guaranteed rights. Armed with this knowledge, how will you take action to fortify your defenses moving forward? Take a hard look at your record keeping, double-check those filing habits, and think about who you might call to represent you if that less than 1% chance becomes a reality. Stay informed, stay prepared, and thanks for joining me on this explainer.